featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities, and joining me tonight's show is John Pearce. He's the Chief Investment Officer for UniSuper, and Steve Lambert. He is the Executive General Manager at the NAB. And if you have any questions at all on investing, please pick up the phone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. Welcome, gentlemen. How are you?
Yeah. Hi.
Now, mate, you've just come back from a holiday in the States, and I'm sure it was very relaxing. The currency goes down. My wife, when she organises a holiday, currencies get... I should tell hedge funds that. Whenever we go on a holiday, the currency gets sold off. How was the States?
Oh, it's fantastic. You know, the States is thriving.
Is it?
Although I must say Hawaii's not... Probably
not really
not
the
a great
States.
barometer, right?
That's right.
It's sort of recession-proof.
Yeah, it's not Detroit.
Yeah, that's right.
What's your interpretation of the United States at the moment? It's very unusual, isn't it? Because they've got this the tapering, and we'll talk about that. But they've got a lot of flux in the situation. They haven't got a clear pathway forward. How does it look from your perspective as an investment option?
I'm not sure about not having a clear pathway forward. I mean, my position on the States hasn't changed for the last 18 months, 2 years. It's an economy that is, unequivocally on the improve. All the metrics are pointing in the right direction. You're going to have hiccups along the way. You're going to have the Detroits, but it's definitely on the improve. The problem is, I don't think the States is the big question for us.
Yeah.
I think it's all about China.
Yeah, I agree.
And it's far more ambiguous.
What's your thoughts of the States?
Yeah, well, same as John's really. I mean, I think it's been pretty steady for the last 18 months or so. I think the interesting thing is, that right through this last 5 or 6 years, the big companies in the US have actually been doing pretty well.
Yeah.
But that's not where the jobs have been coming from. It's now as we're starting to see some improve in the SMEs,
yep.
which in probably 60-70% of the jobs are created in the SMEs in the States. As that starts improving, that's where you start seeing the jobs getting picked up.
That's right. You know what's really interesting? That Bernanke, when he lectured to the parliamentarians, to the Congress, and said, "Don't bring in the sequester," and Obama writes something that he thought would be no chance it could get passed, and then they passed it out of spite and all that sort of stuff. To some extent, do you think Bernanke was right? Because at the moment, the economy still continues on. So it's either the economy which should be supercharging at 5%, or is it going at 1 or 2 because of the fiscal drag? But was Bernanke right? I mean, what do you think? Is it you're saying that there's real growth in that small medium enterprise?
I think the last couple of years you've seen the American banks have got their balance sheets in order. Basically, American banks are looking pretty good at the moment, and they're starting to lend. And when that occurs, and it looks like you're starting to see more lending into the SME sector, they're starting to see opportunities. And that's where these green shoots, or whatever you want to call it, you're starting to get some decent proof around that. The issue for me with Bernanke's comments is always just reminding people, maybe a soft reminder, that guys, you can't keep interest rates at zero forever. And at the end of the day, governments have got to balance the books.
Yeah. There's been that big sell-off in the bond market.
Yeah, but look, Bernanke, I think is absolutely right. Bernanke doesn't want to see drastic short-term fiscal austerity measures at a time when unemployment is 7.5%. But he wants to see long-term efforts taken to reduce the deficit. And at the moment, both sides of Congress are frustrating the hell out of him, right? Because the Democrats don't want to do anything long-term, and the Republicans want, pretty drastic fiscal action in the short term. So that's probably why he's going to resign.
And we look at the problems with the US and the things like Detroit we were talking before we came online. It's the fiscal imbalances around where they get their revenue. It's this sales tax. If you go into the United States and you buy something that says it's $4, you go and give them $4 and say it's $4.13. You go, where's it? It's not $4, and it's because that's not ours. It's a tax. It's a tax you've got to give, and that's very strange because it affects people's behaviour. You see them doing that. They try to move away from the tax, and that's probably part of the problem. That they can't get the money from the people, and when they were trying to do the rebalance, when the Congress was trying to give the money to the states, they couldn't get the money to the people. That's the greatest problem with the United States. It just has the wrong fiscal mix.
Yeah, although I'm not sure I'd read too much in Detroit, Mark. You know, Detroit's, this is a place that's been in structural decline
for a long time.
For a long time.
Yeah.
You know, it's gone with the manufacturing industry.
Well, I think the reality is every country has its own story around how it deals with different sectors of government. And, you know, one of the debates we always have in Australia is around our own imbalance between what the money raised at the federal level and how the states spend it. In America, you've got, the reality is in America, you've got a lot more spending at the local level than we see in Australia.
We've seen that sell-off in the bond market. Do you think at those sort of levels, with 3.5 and 30s, do you think that's a good level for people to start buying? Because clearly that's what he wants. Bernanke wants PIMCO to buy. You know, twist the arm and trying to get him to buy. Does that make sense at those levels with inflation at 1?
We're very short duration in our US bond portfolio. We're staying short, right, but we're less comfortable being short. They're still pretty low. You know, look at 10-year rate yields at 2.6%. Look at closer to 3, they're starting to look much more attractive, especially if inflation is going to be sub 1%. But 2.6 is probably getting somewhere in
borderline
now.
And when you say short duration for the viewers at home, what would the duration be, or you may not be able to say that?
Yeah, no, it's less than 1 year.
Right.
So it's very short relative to the benchmark.
And what's your thoughts on the?
Similar. I actually don't see inflation being an issue in the States. I also don't think the cash rates are going to move much for the next year or so in the US. So a lot of this discussion around the tapering, it's not like it just finishes tomorrow and all of a sudden, you know, the government doesn't own assets. I mean, that's not what's going to happen. He's talking about rates of change, not absolute levels of change. So inflation's not going to be high. I think somewhere between 2.5 and 3 for the 10 years where we're going to see it for a while. And I think, probably does. When it was up around that 275, I thought that probably offered some opportunities. Probably agreed could go to 3, but I can't see it.
With the recent non-farm payroll numbers, the interesting thing for me was that the hourly cost went up quite a lot, went up a reasonable amount. And when I talk to people in the States, they haven't had a pay rise since 2007. And I get the idea of the jobless recovery. I get that. At 7.5%, you can't really come in and say to the boss, hand out. But if Bernanke gets it to 6.5 and it's got some momentum, all of a sudden you might see a little bit of wages pressure.
Yeah, that's true.
And you start to see some inflation, so you see a jobs recovery, which I'm not trying to get you to short US, companies, but you'd imagine that jobless recovery becomes less profitable because there's wages growth. There might be some challenges around them managing that. Though at this point in time, there's no
without
jobs.
a doubt. Look, I'm not sure that inflation will be a major issue because there's still spare capacity there. But US profit margins are at all-time highs. They've been there for some time, and if history repeats as it has for the last 100 years, mean reversion, those profit margins will have to come off. And they'll have to come off reasonably significantly. So there will be challenges.
And it's just a function of...
And I'm not sure the big end of town, as I was saying earlier, I mean, the big end of town in the States has done pretty well the last 4 or 5 years. That's not been the issue. The issue's been the SMEs. And to me, I'll be looking at where's the hiring taking place, where's the wage pressure coming from.
And you're right about that. The big end of town's been actually buying into the UK. They buy Boots, they buy those sorts of companies, and they say, look, I need to spend a couple of $1 billion, so let's go and find those assets, particularly in Europe, which, I know you're worried about China, but Europe is just that Europe's so irrelevant compared to China and us?
I don't think you can get negative surprises out of Europe because you're expecting all the news to be negative, so there's no surprises, right? Look, I'm not that concerned. It makes a lot of headlines, etc. But quite frankly, US has, in terms of incremental contribution to global growth, Europe hasn't really done much for a decade, let alone since the GFC.
That's right.
I reckon that's right, absolutely right in terms of its contribution to global growth. The big problem is don't underestimate the headlines because that's what causes the volatility in the markets. Everyone just there, or you look at something else negative. And the good thing this year, let's be honest, the good thing this year, Europe has not given us the same sort of grief that it did last year.
And it's interesting.
And it'll be interesting. What about next year?
Draghi says we'll do whatever it takes, and no one's ever asked him what does that mean. No one's ever said, right, come on, let's do it.
That was the turning point, right?
Yeah, that was the turning point.
Your point, Steve, I thought it was interesting the reaction to what happened in Egypt. Right? Now, I think maybe the markets are getting a little bit more immune, because think about the Arab Spring. You know, a reaction would have been much more dramatic okay, to those sort of developments. So
we're going to change the head of government and we'll put the army in, and
exactly.
so then we'll catch that in the 6 o'clock news.
Getting a bit more sanguine about that.
Let's go to our first email for the night before we go to a break. This is from Lorna in Sydney, and she writes, I'm interested in inflation bonds. What is a capital index bond? I suppose I can take that. Lorna, capital index bonds are, that's an inflation-linked bond. It is, if you, when a bond is issued at $100, the capital, that $100, increases with the inflation rate. So if it's 2.5% annually, it'll grow up by 2.5%, so it's 100 plus 2.5, and that'll just compound through the duration of the bond. So if the bond's in existence for 20 years, it's 20 years at whatever the inflation rate is. We like them for the savings component, and we like them for the sort of returns that you need, but they don't become the only asset in your portfolio. Where it's very important to understand that there's a portion in which you save, like I tell the kids, and a portion in which you spend. This is just a saving one. Look, we'll now go to a very short break, so if you feel like calling, call us on 1300 30 34 35 for any questions you have on investing, or the email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to Your Money, Your Call. My name is Mark Todd from FIIG Securities. I'm joined tonight by John Pearce, the Chief Investment Officer for UniSuper, and Steve Lambert, the Executive General Manager at the NAB. And they're here to answer any of your questions. So please pick up the call, 1300 30 34 35, and the email yourmoney@skynews.com.au, and I'll get a glass of water soon. Tapering. Let's talk about that, because Bernanke effectively blinks. He says to a grumpy Republican, "Oh, we're going to consider it." The market goes absolutely haywire. What was your interpretation of their behaviour?
Well, the market behaved like feral hogs, as one of the Fed members said. Look, you know, I guess it's like anything in life. You know, you can make choices, but you can't determine the outcomes, right?
Yep,
and that's
absolutely.
what Bernanke. You know, I think what Bernanke's doing is taking everyone through a bit of a fire drill. And
it's a good
before
point.
we actually get to the real deal, let's see the market reaction and warm the market up. All he said is that we're taking our foot slightly off the accelerator, not off the accelerator, just releasing the pressure a little bit. We're certainly not tapping on the brakes. We are still very much in easing mode. So the reaction of the market tells me that there are some people in the market that believe that quantitative easing can go on forever, which is clearly nonsense.
Yeah. Well, what was your thought, your interpretation?
I couldn't believe it. I remember when that week when the market just went, the first week when the market went crazy, I was going, he must have said something else. What else did he say? It must be something
Let's get
else.
the data.
Yeah, and it's the same story. All we're talking about is government's still going to own a lot of bonds. We're not talking about this. It's just the rate of change. And it's the difference between, in my point of view, between a stock discussion around how big something is and a flow. You know, it's a rate of change discussion.
Do you think that the Bernanke strategy is just to hold these bonds? Is he just going to keep? He's got so much 30 years. Does he just say, "Well, I'm going to retire. I've got the pension. I don't care. I've saved the world from devastation through a financial Armageddon." Do they just keep him on the balance sheet? Is that what they do, and make the squeeze happen that way?
Well, he keeps alluding to the fact that he's got a few options, right? He hasn't really.
I don't know what his options are. I'm hoping you can tell me.
Well, one of the things you can do that reverse twist, right? So he sells the long-term bonds and buys short-term, and lets that run off. Okay, that's one of the things he can do. But look,
that would be expensive.
Look, when they start selling, let's hope that you'd assume that the US economy is in absolutely rude health. And they can absorb.
And at the same time, they are bonds, right? So they're maturing. So you're going to get a natural runoff anyway in the existing portfolio. And as John said, you can start sort of playing around with keeping the same size around durations.
And no, that's the key about the duration. Actually, you're coming down that yield curve. To your point, if you're at 3.5 and all of a sudden a little while later you're at 2.5, you're not so much worried about that sell-off in respect. You don't own that anymore. You own this. Let's talk about equity markets. Where will they be? In terms of the momentum, I'm curious about how the US is really. You get out and it's new highs. And you come to the market and Goldman's are writing, come on, get this horse up. So what's your thoughts on those both markets? How are they playing out? Because we feel like we're a little bit soft and they feel like they've still got that strength. How do the two different markets look to you?
Yeah, well, I mentioned profit margins before and they look high. Look, the equity markets the economy is improving, but the economy has to improve because equity markets have run pretty hard. And look, we were...
Now you're talking US, right?
US,
yeah.
And last time I was here, we talked about the equity markets with a fair bit of conviction.
Yeah.
Now they're at fair value. I don't think that they're overly expensive, but for those of you who have actually been in it for a while, it looks like a reasonable sort of place to take a bit of profits and digest it. I think, there's always going to be a chance to get back in when there are other hotspots in the world.
Yeah.
The Australian market is obviously lagging the US market, but with good reason, right? I mean, we've had an inflated currency. The nominal GDP is miserable.
Yeah.
So we've got downgrades in companies. We just had a spate of downgrades this morning. Another couple. Look, this is going to take some time to play out. We need another couple of quarters of with a competitive currency.
Yeah.
Some signs of a pickup in nominal GDP. But at this stage, I think the premium in the US market is justified.
Was it Orica that had a 10% drop today? So as an equity guy, what do? Do you call the bloke up at Orica and say, hang on, that just seems to be really irresponsible to my mind. And I'm not an equity guy, so I don't know.
Well, you have to distinguish between stuff that management has got control over and stuff that they haven't. All right, with a lot of these resource companies, clearly, things are out of their
control. The mining services business looks terrible.
Yes, that's right. So where it's been really a management error, error of judgment, etc. We have very, very robust discussions behind closed doors. But in other cases, when they've got no control over commodity prices, etc. Even obviously weather conditions that impact supply.
What about yourself? In terms of those sorts of organisations, as a banker to those organisations, and they put their hand up and say, "Here, big mistake." Do you go to the credit people and say, what are we doing here? Does the bank then sort of recalibrate? If they say their earnings aren't as good, does everyone in banking say, hang on, what are we doing with these guys in lending? Does it become a compounding squeeze, if you like?
Sometimes. Sometimes. I mean, typically...
Not that banks want to hurt corporates, I know that.
No, but typically you're trying to get in front of a lot of those changes, and typically when you're looking at lending money, you're not always thinking about the best case anyway, right? So when you're making a credit decision, you're looking at, okay, what could go wrong? What are the different scenarios you face? So quite often what comes to pass, whilst the market then says, oh, that was a bad scenario, it's possibly something you've already factored in.
Yeah, right.
At the start of the transaction as a lender.
Makes sense.
But the point around that John made around the management decisioning is a key factor.
Yeah.
And sometimes with these things you go, well, hold on, we weren't told this beforehand, we weren't given any heads up.
That makes you feel very uncomfortable.
Yeah, you start feeling uncomfortable.
And it's that one day mismatch, and it's a long-term loss, isn't it?
I think the other thing is you've got to, as a lender, particularly lending to big companies, SME as well. I mean, you're there for the long haul. I mean, as a bank, we've been around 150, 180 years
Can't
or
do
something.
3-month money.
Absolutely.
We have our first caller for the night. It's Eric from Queensland. Hello, Eric. How can we help you?
Oh, g'day, panel. My question just in relation to how the gold prices interrelate with these 10-year Treasury bonds. Like when Bernanke came out last week, my gold equities went up. This week he says the same thing, and they go the other way. And the other thing is, surely all this money they're printing up there is going to, eventually increase inflation, which is supposed to be gold's friend. So I just want to get some comments on that, please.
Absolutely. Can I start with you on the gold?
Yeah. So gold, I'm not a great.
No, but
I'm not a great fan on gold. So gold for me is, over time, I think this linkage of gold as an inflation hedge is really diminished. So to me, gold is increasingly every year just acts like an industrial metal, and it just goes on demand supply for gold. The historical linkage was, of course, it was an inflation hedge, but I think these days the number of people who hold gold for that is a small subset of what it used to be, and you don't have the same linkages.
I mean, Buffett really took it to the cleaners, didn't he? He was able to articulate, because that's his skill set. He was able to articulate the hole that the gold would hold, and the productivity that it created over a period of time.
Eric, I'll just make another point. Japan has been in one sort of mode of quantitative easing or another for the last 2 decades, and it's been in a deflationary spiral. So the link between quantitative easing, printing money, and inflation is very tenuous. So if you're trading on the back of some short-term correlation, I'd advise not to.
Yeah, I think it's very hard to trade gold, particularly when you don't have that control of it anymore. You are at the whim, and when they're being buffeted as much as they are, it's probably best to just take the hit and step back and look at whatever your assets are. So, but I do agree that there's an inflation piece in it, but we tell most of the people just buy an inflation bond. Look, we will go to our next break, but please feel free to call us at 1300 30 34 35 or email yourmoney@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. My guests tonight are John Pearce, Chief Investment Officer for UniSuper, and Steve Lambert, who's the Executive General Manager at the NAB. And we're going to go to our second email for the night, and this email is from Bill in Melbourne, and he writes, I want to try and understand why everyone applauds the lower dollar. How does it in any way assist the average person who is cash strapped, and now with fuel prices increasing, the costs of delivering foods increases because of fuel costs? How does that help the aforementioned punter? I saw the Chinese buying iron ore at whatever the price, and was they there? They do it for a long time. I'm getting a little bit lost. Farmers are ploughing their orchards and they cannot compete. I think he's just basically very unhappy about the dollar and how it's affected everyone else. What's your thoughts on the currency issue?
Well, as it relates to specific individuals, those observations are absolutely right.
Yeah.
But the reality is, when the currency gets out of kilter with the fundamentals, it makes it an uncompetitive situation for lots of industries that don't have the same pricing power as an iron ore industry.
Think of manufacturing, think of the car industry. If you're working in South Australia.
You've got an oligopolistic industry structure in the iron ore, and the Chinese are price takers.
Yeah.
Whereas you're in the tourism industry, you're a car manufacturer, or even my industry, the tertiary education, where it's very price sensitive. Indian students dropping off because of our currency. So at a macro level, we don't want a weak soft currency, but we do want a competitive currency.
Yeah.
Because overall the nation prospers. And
essentially, Steve, when you go out and because you're an internationalist, because you've got to go and get money out of the United States and talk to those guys. The currency where it was everyone says it's driven by the rating of the government, the rating of the sovereign, and where the interest rates are. Is that the core of it? That the high interest rates compared to the rest of the world made it very attractive?
Yeah. So we I think the sort of model I use when I think about the Aussie is basically two inputs. One is commodity prices, either in dollar terms or trade weighted index terms, and the rate of change of that. And the second bit is interest rate differentials, and predominantly around the US dollar, but also around the yen. So I think they're the two key factors. And we saw the Chinese buying, basically whatever we could put on the boat fundamentally. So very strong prices for our commodities that we were selling. So that was a big factor. And then of course, you have the Australian government and just Australia generally is seen as a safe haven. So the big shift of assets into Australia, into Aussie government predominantly. Because not just solely, but then we had the interest rate differential.
Because you look at the volume of buying of our sovereigns, it's certainly wound back from offshore. They're not buying as much of our debt, as much of our sovereign debt, and I wonder if that was just a consequence of how crazy it was at that point in time.
I think it's
Europe, everything was going nuts. Central banks everywhere.
I think that's definitely true, but I think there was a portfolio effect. You could actually argue that pre-GFC, there was a lot of sovereigns out there that had very little Aussie government.
That's what I mean, yeah.
They had dollars or they had euro or yen, but all of a sudden the Aussie people said, well, hold on, I don't really want to hold yen at zero. I don't now want to hold euro at zero or dollars at zero.
Yeah.
What can I do with my money? And there was that portfolio effect. And because Australia was not as affected, Canada had the same impact. And it was a good place to put.
And there's just a report out this week about the IMF. They've now separated Canada and Australia as a currency to talk about what it's holding because of its significance, which is, clearly that, to your point, it's part of everyone's portfolio and people are looking to do that.
And I think the point is the rate of change. It's like we talk a lot about first differentials tonight, but the rates have changed. But a lot of that new buying from people like, from the central banks of the BRICS, from Brazil, from Russia, India, China. A lot of that's happened now. Who's the next lot of new money coming in?
Deal done.
It's not as obvious, and now it's going to be around portfolio shifts.
And now the Rudd government balances every budget; they don't need bonds, so it's going to be quite all right. Okay, Mr. Abbott will do the same.
Structural surplus.
Structural surplus. That's right. Yeah, that's right. That just means we work harder.
Deficit.
With the lower currency, are you worried about the imported inflation? We've had Chris Joy here. We had Vincent Hua last week. talking about importing inflation. Is that something you're worried about?
Well, you have to, for it to be a problem, you need a strong economy, because otherwise they can't pass the price on. So at this stage, I think there'll be enough slack in the economy to absorb it, and I think the net benefit, there'll still be a big net benefit from a lower currency. I think when it's more, when the currency got to, say, 65, 70 cents in a hurry, that's when you really start to worry about things. But a gradual decline, even though it's been pretty quick, but to these sort of levels, even a slightly lower, I think it's...
Are you the same, Steve? What do you think?
Yeah, I think so. I think well, you've got to distinguish between underlying and headline.
Yeah.
And headline, absolutely, and I think the last caller, Bill, made the point around fuel prices. I mean, petrol prices.
It is phenomenal.
Oil is still very high, Aussie dollars down. I'm probably going to get very high petrol prices this week, next week.
Yep, mate. The kids are out on the bike. They're not going anywhere in the car. They can ride.
Shank's pony, mate.
That's right. Shank's pony.
Walk everywhere.
That's right.
It's good for you.
Absolutely healthy.
So I think, but the reality is in a lot of the data, the official data, that will get stripped out. So you have to make the distinction between that, the underlying, and I agree. John's point's absolutely right. We're not. The economy is trudging along. There's no. I don't believe there's any real sign at all of import inflation at the moment.
But does that mean? I'll paraphrase Vincent, because he was making the point that just means that in terms of the JB Hi-Fi, all those organisations, all those retailers, obviously you must be a seller of those from an equity perspective, because they don't have any good margins as it is because of all that internet business and all that sort of stuff. Does that just put a lot more pressure on that part of the investor segment?
Yeah, look, there'll be impacts on that part of the investor segment, but it's only one part, of it. And JB Hi-Fi's got other competitive advantages going for it as well, right?
Yeah, right.
I mean, so I would look at, just because of lower currency, sell JB Hi-Fi. I don't think the correlation...
Don't make that link straight away, but you'd be looking for them, how they're going to manage those margins and how they adapt, because clearly they've adapted a lot. It's been tough. Yeah. It's already been tough. Yeah. We're going to talk about it a little bit after the break, but before we go to the break, I just want to find out, with that volatility in the rates, Steve, does that make it harder for your job? If you're taking, your job is to take banks, take organisations to the United States. Is it harder right now with that last spit that they had with interest rates? Was it harder to bring companies there? Were they asking too much, or is it?
I think what happens when you see volatility in the bond markets, it doesn't matter if it's the States or the domestic market or Europe or anywhere really, it causes investors just to sit back and say, well, do we want to commit money at the moment? Is next week a better time to invest, or is it, I'm better off just sitting my hands? So what typically happens is bond markets will close for new issuance for a while. And we've seen that in the domestic market.
But it's not like the GFC close. It's just
no. It's just like a temporary, next 3 days. It's not a great time. Or hey, if you just wait for a bit of a pullback, and maybe more bonds are sitting on banks' books rather than out to investors. So.
There's also a time you get some great bargains.
Right? Yeah, it is true. As in, from an investor's point of view, from an issuer's point of view.
For the viewers out there, when you see these temporary dislocations and credit spreads. They're any relation to the underlying credit. Macquarie Bank last month in Europe, you could buy margins, their debt at 450 basis points. The swap rate, the sub debt. Okay, now Macquarie Bank is a good sound bank.
We're trading Downer at Downer 18s at over 6% now, and you're saying, okay, that's Downer, and that's a senior bond, and look at where term deposits. Look at where you think cash rates are going to be. They're going to be low, and you're going to get effectively doubled cash for a period of time, and cash rates aren't going up.
So I think what happened though, when you get some stability in the market, and that's when you then start seeing a lot of issuance. So saw that last night in the States.
Lots of money coming through. Look, we'll have to leave it there, but we'll be right back. My guests will have a very short break, and they're here for any of your questions. Please feel free to give us a call. Welcome back. On the panel tonight we have John Pearce, the Chief Investment Officer for UniSuper, and Steve Lambert, Executive General Manager for the NAB. If you have any questions about the share or bond market, please pick up the phone and call us on 1300 30 34 35, and the email yourmoney@skynews.com.au. Steve, I wanted to ask you about the bond issuance, the ANZ, Westpac and NAB have come out with bond issuance over the last week to different customers, different types of customers. So, you can go to institutional clients and write a cheque for $1 billion and it's X amount of people. Not that many, because to your point. And then there's a retail offering that'll go to a Tier 1 paper and a subordinated piece of paper. How do you think the market, the buyers of this paper are interpreting the right credit spread, the right cost? Do you think there's a lot of analysis on this going on from their advisors, or do you think it's ANZ, it's Westpac, I'm just going to buy it?
Yeah, it's a good question. I think one of the things, and we've talked about this before, Mark, around, I think one of the impediments for development of the market, and one of the things that we're trying to push heavily here in Australia is around education, around investor education, around different types of bonds. It's not just about the name on the top line. It's around where does that bond sit in the capital structure? Where does that bond sit upon repayment in case the company gets into trouble? So the three banks you just talked about obviously work for one of them.
Clearly.
So last night we did a deal in the US it was a senior deal. It was just a simple corporate bond at one margin. That margin might have been, say, 90 basis points, something like that, 95 basis points. You saw a Tier 2 deal, which was done by Westpac. And a Tier 2 deal is a capital instrument, so it's counted in the capital, Tier 2 capital for regulatory purposes, which was the deal that Westpac did at around that, I don't know, 230, 240, whatever it was. I can't remember what it was. And then ANZ did a different style of deal, which was more of a Tier 1 deal at the 340. So there is a rational reason why they're priced differently, and the higher the risk, the greater the return. And that's true for just about anything. So the key is not just to look at the name, it's what type of bond, what's the payment profile.
Because let's talk about the report in a second about what you came up with, but you're saying Westpac's at 2.3 for subordinated, and you're saying Macquarie Bank was at 4.5, so almost double. And that's where, if the viewers were comfortable with what capital structures mean, they could say 2.3 versus 4.5. It's the wrong price.
Well, there's a window of opportunity though, so that closed up. You couldn't go and buy Macquarie now. And I was saying, those periods of dislocation, bad for issuers, but fantastic for investors. Australian banks are fundamentally very, very sound. So whenever you've got a big blowout in spreads like that, we always see this great buying.
And that's just the name of the game. You issue when you can and you invest when you can, and sometimes you get the benefits and sometimes you don't. Tell me about the report you're putting out, and like the bond market in general. Like, you've done a lot of research. Do you want to talk to the viewers about what you're doing now?
Well, we've been working with the Australian Centre of Financial Studies out of Melbourne over the last year, around trying to commission a series of reports from themselves around trying to lift the education. A series of resources really to try to talk to people around bonds and around retail bonds and the need for a corporate bond market in Australia. So the first report came out in, I think, January, February this year, which was really around credit as an asset class and bonds as an asset class. Probably easily understood at the institutional level, but probably not as accessible historically for a lot of retail investors. So that came out. This last report, which we saw was released this week, was more around getting in a bit more detail around bonds. Like going into this point around different types of structures, what they mean. A bit of the terminology, and it's definitely available on the NAB website. I should have remembered
the
what
NAB
the
website
is.
But
it'll be there somewhere.
We'll find it.
.com.
.com.au.
But
3 years from now, what does the bond market look like? Do we, what's the transmission mechanism for the viewers at home? What's the transmission mechanism? In other words, can they just plug on online? Will NAB, the NAB ads you've got now? Do you think you'll have ultimately a suite of bonds you can go and buy and suite of equities? Is that what happens?
I think we're trying to get there, and I think whether that's in 3 years or 5 years. I think, to me, the three things that need to change to try to get the domestic market a bit better. One is there needs to be a bit more of the regulatory playing field to be a bit more consistent. Second thing is around education. We think that's a really big thing. And we think the third thing is around accessibility. So there definitely needs to be more work done to be able to allow a normal retail investor to be able to buy a bond as easily as they can buy an equity. And that's where we're sort of trying. But the three, you can't have one without the other. If you sort of have the accessibility without the education, I think that creates a lot of problems, and that's something that we wouldn't be advocating. So we're trying to do it in that sort of order, really.
It certainly is incremental steps. We're bringing a new bond. We've been mandated for a corporate bond. So it'll be a $30 to $50 million 6-year bond. We're doing the book build now, so we're trying to get some feel for the clients. But it's a fixed rate return. Let's say it'll be over 7%. We'll just get the soundings. For an ASX top 200 company, well, forget this bond bubble. Everyone is ringing up saying, okay, I want to buy that. I want to know more. I'm engaged, so I want that. And it's what you're saying is accessing the bond, it's getting the information, it's being able to find it easily available. I mean, at the moment, we've got Andrew Gordon doing a good job on it, but it's clear that is where a growth for some parts of the businesses. The stockbrokers, I would have thought they'd be trying to get more of that model, don't you think? Some fixed income to corporates, bring it up, because the equities don't seem to have that same sort of support at a retail level.
Well, the major culprits are our big banks.
Yes, I know.
They've been too willing to lend to these corporates, and they should force them into the bond market, and we would have potentially a more flourishing bond market. And that might happen through time, with the banks become a lot more discerning the way they allocate their capital and price their capital, etc. Capital becomes more scarce. We could actually see a bond market flourishing because of that. I
think you're right, because I was going to ask, my next question was about the Basel III. I think that creates a change in the way banks do business, and we can talk a bit more after the break. But I think you're going to become more margin takers in terms of, but not. You can't rent the NAB balance sheet. I just don't think that's going to happen. And I think you'll be going to people like John and saying, let's partner up. I'm going to bring my corporates, and John's going to be familiar because of the equity side. I guess that's going to be a narrative that you guys would be having, wouldn't you imagine? Because
it might, but the Australian banks are very well capitalised, and certainly they don't tend to have much problems with the funding either, because they're very highly rated. So I think we could be waiting for a while.
I think so.
The banks, at the moment, none of them are looking to shrink their balance sheets. That's for sure.
Yeah, I think that's right. Look, I think Basel III will be, as banks respond. And it's not just Basel III. I mean, Basel III to some degree is used as a bit of a catch-all for a whole bunch of regulatory change that's going on in the banking system globally. And banks have to respond to that, and banks are responding to that. And because banks are such big beasts, the way we can do things is it needs to be somewhat nuanced. But I think there is, in the Basel III and the regulatory changes, the seed of the need for the banks to think around providing alternative funding to Australian companies. Because at the end of the day, what the banks are trying to do is basically fund Aussie companies so they can invest, invest in productive assets, allow people to buy their homes.
And you're right, we're going to go to break, but a nuanced movement from a bank is millions and millions of dollars.
Yeah,
I mean, that's because people don't realise how big they truly are. We have to go to another short break, but please feel free to give us a call on 1300 30 34 35. And if you have any questions about investing, email yourmoney@skynews.com.au. We'll be right back. Welcome back. We're still taking calls, so feel free to call on 1300 30 34 35. Joining me is John and Steve. Let's talk about Unisip. How's it all going?
Well, rising markets are good for
we love that.
Industry, for institutional funds, aren't they? Just it's good, Mark. For the industry. There's more confidence in the investor base. A lot of there's not as much switching going on. People seem to be generally comfortable with their positions. In volatile markets, you've got people taking their money out of equity funds at the wrong time, and or putting money into equity funds at the wrong time. But we've seen a fairly calm member base. Just one stat that members might be interested in. Our balanced option, and it's the median balanced option is returning about 15% for the last financial year.
Wow!
So we did some of the stats. If a member had actually foreseen the global financial crisis, perfect foresight, put all their money into cash. Before the crisis, they'd actually now be worse off.
Really?
Than if they just stayed into a balanced fund. So, it does say something about staying the course.
I can't tell you how many people who are professionals who come on the show and say, when I say volatility, they say you've got to try and look through it. You've got to work out what your underlying asset is like, and then stay with that asset. Has there been any question without notice. Has there been any, with the government trying to change the way they fund universities and the like, have you seen from your client base any of the pressure saying, listen, they're trying to cut our fees, and is that sort of affecting their...
No, not it hasn't come through.
It hasn't come through because they're saying, I need more money to retire or whatever it might be.
No.
What about the idea, because UniSuper, how much is there in UniSuper? Is it
about 37 billion.
37 billion.
Yeah.
So are you struggling to find assets to buy? Is that potentially going to be a problem? Because some of these are $100 billion companies.
Yeah, look, you've seen the Canadian pension funds, for example. Now they're 200 and 300 billion, and that's why they're so active in, in Australian
by any
infrastructure,
street they can find.
Look, I think it's going to be sector specific, and if you look at something like technology or the healthcare sector, that's always been a problem. For a $5 or $10 billion fund, sourcing those sort of assets are a problem. Whereas, if you want to get materials or financials, Australia has got a pretty deep, industry there. So I think it is going to be sector specific. Clearly, we've already outgrown certain sectors. It will be more. Infrastructure's one of them, where we're heavy holders in Sydney, Transurban, etc. But the listed market is shrinking.
They just keep privatising these things.
That's right, privatising or M&A activity. So
APN into Investra.
So we're looking now at allocating funds to a global infrastructure mandate, because the Australian market is actually
just on that though. I mean, just to this other side. I mean, as you said, the Canadians, the big Canadian, like the Ontario Teachers and OMAs, etc., really big, $200, $300 billion funds. So probably a multiple of our biggest funds, really. But consolidation. If you think about, there are still a lot of super funds domestically, and how do you see that playing out, John?
It's a lot slower than people think. Because consolidation of two super funds requires one board to sack themselves. And you don't meet too many people that like to sack themselves.
No.
So, I mean, rationally, if it's based on pure economics and rationality, there should be a lot more consolidation a lot quicker. But, that doesn't always dictate what the outcome is.
I suppose it would be dictated by performance. If they, under stress, if they didn't perform, you'd see members saying, hang on, I want to go from Hester into Besta or whatever. You'd see some movement around that, because that happened with the union sector. There wasn't a performance, and so.
But I think the point is that even though there's a lot more choice, at the end of the day, the default fund is still must still be getting the bulk of the money out of that industry, isn't it? I mean,
there's a lot less. There's a lot more inertia. In super funds than people think. At the margin, you have got people who trade their super funds, but the vast bulk of members, it's a set and forget default option.
Well, I suppose that's because they're busy working. It's a really busy life. You're doing all your work. You're assuming that your financial planning is smart, your plan is nice, or your industry fund is knowing his job, and it's you just assume that because you're busy trying to get kids dressed and go to school. I mean,
and for the vast bulk of members, a balanced option over long term has served them pretty well. Right? We've obviously had hiccups along the way, like the GFC, but as I just mentioned, you're now.
You should have stayed along and go through it. Tell me, we spoke at the start of the show about China. What is your concerns about China? Is it the quality of the information, or because if I look at China and there's 1 billion people, there's one government. Well, I know what's going to happen. They're going to give them whatever they want because they want to stay in power. Like if you talk about a board sacking themselves, the Chinese Communist Party giving themselves up for rent ain't going to happen on Monday.
One thing political certainty.
That's right.
They're going to
self-interest.
Running the show.
Self-interest works very well for the politicians. So, what is the concerns?
Look, the concern is. It is quite opaque when it comes to information, right? But that's always going to be the case, always has been the case. The concern now is more short term. The new regime seems to be far more resolute in trying to get rid of the excesses in the system, particularly the credit bubble there. So where we've had hiccups before, the policymakers have come to the rescue, they pump things up, etc. These guys are saying, no, we're going to let you guys endure a bit of pain. Now, a slight bit of pain for China is a lot of pain for Australia. All right? It's they are the marginal buyer for pretty much all of our exports. All right? So 7.5 to 7 doesn't sound like a lot, but
when he said it, I thought, what are you saying? Why are you doing that? It's not like Bernanke trying to smooth it and prepare us for it. It was something like. Then they go and say, no, he didn't mean that. We were misquoted. I don't know about that.
So that's it. But what they're doing is right in the medium term. We should benefit from a much more sustainable Chinese economy, even though it might be 1% slower. But short term, that has an impact.
You have the same view?
Yeah, broadly. I mean, I think it is interesting that the lack of knowledge really, in deep knowledge generally around what the financial system looks like in China is a bit staggering. I mean, it's reality is it's a closed economy. It does not have a freely floating exchange rates. It's very good, or it's difficult for overseas investors to get money in and out. It's actually a very large bond market, but it's all domestic.
Yeah.
And it's got the big banking system, and the banks there are huge. They're some of the world's largest banks in terms of market cap.
And clearly part of it's cultural. They don't really want you to know because it's not in their interest either. We'll talk more about China in a second. We'll be right back in a moment with our closing remarks from our guests. So please stay with us. We'll see you soon. Welcome back. My guests tonight are John Pearce, Chief Investment Officer for UniSuper, and Steve Lambert, the Executive General Manager at the NAB. We'll end up quickly, but I'll talk a longer subject. We've got the phony war on, and that's the election. So we haven't called an election, but they're in election mode. Is the change of leader, does it affect business? Do you think it has? Are everyone sitting back saying, before I make a business decision, Steve, are they wanting to see what the election looks like, or do they just go about and say these people are just over there making around?
I'm going to probably leave generally these ones alone, Toddy, but...
No, I just mean the confidence. I mean, everyone is focused. So when I talk, I mean, previously it had been a shoe-in. It's going to be a change in government, and we would sort of work around what they were doing. They're going to get rid of the carbon tax, and you could sort of plan. And now it's got closer, but you don't know where it is. So what plans do you make? I'm not choosing a side, but does it mean that where you had previously just assumed something was going to happen, and you could look at their policies and say, oh well, this is what's going to happen? I guess. You don't have an election date, but you now think, what's going to happen? And it's hard to carry on.
Yeah, I think the other bit is that there's just that it dominates so much of the headlines. There's it just takes a lot of oxygen out of other sorts of thinking and other sort of discussions that could be had. So I think that to me is one of the issues. I'm not sure that in our system that who wins per se determines I'm sure the marginal investment decision, but
I think it's exaggerated in terms of the real impact on medium-term impact on economies or markets, right? And if you actually asked business people, they will talk about political uncertainty, but then if you actually drill down, say, all right, but what decisions have you put off? Nothing. All right. The reality is that they haven't.
I'd like to talk it out.
Yeah.
We have got another call. We've got Tony. We're about to wrap up, so we'll get to Tony quickly. He's from South Australia. He wants to talk about banks' mining exposure. Hello, Tony.
Which bank has the largest exposure to mining services companies? Reading through a lot of the company announcements by the small mining companies, some of the banks have fairly large unsecured exposures to them.
Thanks for the question, Tony. I'm going to get Steve to answer in a second, but I will say this. When I said the banks are so big, it's hard to come to grips with how massive they truly are. So their exposure to the mining services sector, I think, will be small as a byproduct of their entire size. Their massive exposure is the mum and dad mortgages. That's their massive exposure. You look at these banks and say, what are you? Well, essentially Westpac's a mortgage business.
Yeah, so
all due respect to Kurt Zuber and the guys there, but
the Aussie banks all have sort of 50 to 60% of their total balance sheet would be in Aussie mortgages, mums and dad mortgages. But like all the banks have exposures to basically every industry in Australia. That's sort of our job, is to fund Australia. Typically, the way we manage our risk is typically at three levels. One is around individual exposures, individual companies.
So Bolt, Longair, downgrades again, you'll be maybe pushing them a little bit harder, but
we'd be doing
somebody else is going up.
Yeah, exactly. The second thing is around industries. So you have views around which industries at different points in the cycle you may want over or underweight exposures, and the third thing is geographically. So that's how banks measure their exposures, and we'll have views around certain industries being better than others at certain times in the cycle. In those industries, you would, if you could, you try to manage exposures to industries you may be worried about.
That'd be the same for you from an investment.
Yeah, it's a very logical question to ask. It's a question that we ask all the banks
banks,
when we meet
yeah.
them after they announce their results. I've been actually very pleasantly surprised at how small their exposure is to mining services. It's very low single digits. Surprisingly, well maybe not surprisingly, a lot of the foreign banks have
they want to buy share.
Much greater appetite for lending to our mining companies than our domestic
Isn't it
banks.
interesting? Because they don't have the mortgage book. They want to get into the business. They can't get a mortgage. They've got to go do that. Look, that's all we have for today. Thank you very much for joining us. I'd like to thank John Pearce for joining us, the Chief Investment Officer for Uni Super, and Steve Lambert, the Executive General Manager for the NAB, and to you all the viewers for the emails and the phone calls. And a special mention to my friend Bill Osborne, who's in Westmead fighting the good fight. All the best, Bill. Hope it works out all right. Until next week, I'm Mark Todd from FIIG.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.